Good evening, everybody. All right. Hope you're staying warm. I think we're down to 0 temperature here in Pittsburgh. All right, tonight what we're going to do is I've got Gordon Scott and Joseph Anderson. They're part of the Candlestick Forum training crew that you might have, some people have been asking, what are these phone calls we're getting for training? And we've been working with Gordon and Joseph for over a year to get them kind of assimilated into candlesticks. But the reason we're doing that is through the years I've been teaching people how to use candlestick analysis, which is my kind of concentrated analysis without all the other technical indicators that people use. And so I can train reasonably well trading or showing people how to use candlesticks, but these guys know how to train people on using the whole area of technical analysis with candlesticks incorporated into it. So we're going to have Gordon come on. He's going to show what we've got set up, and then Joseph will follow him. So this is going to probably take about 30-40 minutes, and when we're done, I'll do some charts afterwards. So with that, I'm going to have Gordon come on, and Gordon, let you show or tell everybody what we've got going as far as the training elements of the Candlestick Forum right now.
Okay, terrific. Thanks a lot, Steve. Appreciate your having us here tonight, and appreciate the opportunity to be here. I want to take some time to tell you about some excellent opportunities that are coming up in the market that you may not be aware of, or that you may not know to look for. The market is kind of slowing down as it inches higher. I mean, that's normal. When you get a bullish market, it reduces its volatility. But then what's going to come next? If any of you happen to be part of the presentation that we did with Stephen back in September timeframe, early September timeframe, we did a remarkable presentation where we called the fact that the market was setting up the way it was. In fact, we stated the fact that it was possible the market was set to crash. Didn't know if it was going to crash really big or really small. It turned out that for a short while, first couple of weeks in October, it did. It was a mini crash, but it came right at the time that we said it would. Late September, early October. And the shortest it would last would be 2 to 3 weeks, about the way it went. And if it was that short, then we'd have a strong bullish move afterwards. If it went longer, if it went 8 weeks, it could set up for a big bearish year for the year to follow. Well, the latter scenario didn't transpire, but the early one did. And that was a pretty good call. I mean, sometimes you get close, and other times you get it right on. Well, this is one of the times we got it right on, and I'm just really excited to have the opportunity to maybe do that again. We'll see whether or not we can be that good. But I want to tell you the sort of underlying thought that was behind that, and why that same concept could put us in front of another similar setup. And that similar setup could create an excellent trading opportunity for you. So the market is setting up again. And here are the key characteristics that we see out there right now. So February rose dramatically, but in general, last year's February rose dramatically. And the 2015 year started poorly, making investors nervous, but they've kind of gotten over the nervousness now and jumped up off of support. And February has again been a strong month so far this year. Now, March, as a result of the fact that February rose dramatically the way it did last year, March could bring some selling motivated by tax benefits. And this is part of what we talked about 6 months ago, but we'll show you how it sets up here too. So if we were to see some selling in March, depending on how much selling, see right now it does not look like the markets are set up to go strongly bearish. In fact, it looks more like they're, even if they do get some selling going, that selling will likely be limited, and then what will follow after that will be more bullish continuation. So what that means is, should we see some selling that begins in early March, and that's about when it would begin, and it lasts anywhere from 2 to 4 weeks, and the shorter it lasts, the better the bullish move on the upside. The selling would create a pent-up demand for stocks, which has been building really all the way since the beginning of the year, and that could drive prices higher quite rapidly. If you're anticipating that, if you're ready for that, that can be a very profitable moment for you. So we're going to give you an idea of why it would happen if it does and how you would recognize it. And so really what we're talking about is the potential for you to be get ready to be a buyer. Now, really, would you want to do that now? I mean, after all, the market's on brand new highs. It's been going up for years and years, and so many people are talking about a crash, and the market is in bad news. And I mean, there's no shortage of bad news. We've got Europe and Greece having troubles all over again, and I mean, really, is this the right time to think bullish? Isn't really more time to sort of back off and think bearishly? Well, here's the thing. If you have a bearish market setup, like these selling periods, one of which I'm going to be walking you through here, that we anticipate may be coming up. If you have a bearish market setup that fails to follow through, just like 6 months ago we had a bearish setup came along, but it only lasted 2 weeks and did not follow through with taking out the lows and turning into a bearish trend. When that occurs, when a bear setup starts but then fails, then the longer term, stronger bullish market takes over and resumes. And more often than not, sometimes it just goes sideways, but more often than not, you get a bullish move that comes up if it's a failed bearish move. See, long-term bear markets, those kind that don't fail, the kind that turn into 2001 and 2002 or 2008, these kinds of bigger bear markets, they take a while to set up. They don't just snap in out of nowhere. Go back and look at the charts for the past 100 years and you'll see this is true. They don't just drop. I mean, sometimes you get a big shock, but then the market rises right back up. And what happens is they sort of go back and forth with increased volatility for a building period of 3 to 6 months. And you got to see that. Now, we did see increased volatility in January. And if we were to see more volatility come in March, see, that's the beginning of it. And we start getting that big up and big down kind of thing, then somewhere further on in the year, there could come a moment where we get a serious bear market. But it's going to take a little while. It's going to take a little while before that can really set up. And what happens is that during that 6-month period, when you come to a place of support and you rise back up, you will often make a new high, if not close to it. So if the market gets more volatile, starts stretching apart, hey, that's a reasonably big distance that it can move going back up to make its new high. And that's sort of what we saw just here in February. January had this big range, and we were down at the bottom of it, and the market came up and has come up quite a ways just in returning to make new highs. So what if that were to happen all over again, only this time you could anticipate it? Wouldn't you want to know that? Wouldn't you want to have the opportunity to do that? It seems attractive, right? Okay, so let's see what you have to do to prepare for that. Here's the theory. Here's what's going on and why these sort of things happen in a way that would help you anticipate and reasonably expect that you could anticipate something in the next month or two. there are periods of time. Now, this is a real, 100,000 foot level oversimplified chart, and I know it's kind of hard to read. I'm just showing you how many times this sort of pattern has occurred over the past 17 years. It's what I call a 56-week pattern. This 56-week pattern, the idea behind it is if you get a period of time where the market sort of sells down a little bit and then rapidly rises, then what that means is that you've got a collection of buyers. They might be retail buyers, they might be institutional buyers, they might be foreign buyers, non-US that is. It could be anything. The whole idea is that they happen to buy right at the same time or very near the same time to each other. Now, if you're watching traffic on a freeway, to make an analogy, if you're watching traffic on a freeway and you see the freeway makes a jam at 8 o'clock in the morning, you can reasonably assume that that freeway is also going to make a jam around 4 to 5 o'clock that night. Well, what if all of a sudden the freeway made a jam an hour earlier for whatever weird reason? Everybody in this town decided they wanted to get up and go to work at 7, right? Is it not rational to expect that somewhere a little earlier, 3 to 4, might come the heavy traffic time? I mean, it depends on what the circumstances are, but I think you get the idea. A certain clump of people going in at the same time means a certain clump of people could potentially be coming out at the same time. So why is 56 weeks important? Well, let me explain that. So the government gives incentive to longer term players in the market. If you buy a stock and you hold it for longer than a year, you pay long-term capital gains taxes, which are typically half of the tax rate that you would pay on ordinary income. If you buy and sell a stock for less than 1 year's worth of time, just a month or two or a day, it doesn't matter, anything less than 1 year, then you pay ordinary income taxes. Well, if you're in a very low income tax bracket, so it's just such that you're not paying any taxes at all, you don't notice that. But if you're in a very high income bracket, as a lot of stock investors are, then you might be paying 25, 30, 35% on ordinary income. And if you had a significant chunk of money in the market and you said, I'd rather get taxes half off, thank you very much, just pay 15% rather than 30%, I'm going to hold for an entire year, right? Now, if one person makes that decision, or 2 or 5 or 10, nobody cares, nobody notices. But if 10,000 people all make that decision around the same time, then a year later, those same 10,000 people are going to be tempted to go ahead and take some money off the table if they've had a reasonably good year. Well, as it turns out, 2014, for the most part, was a good year. There's about 10, 15% or more that you could get from just holding NASDAQ stocks, for example, and depending on when you bought them and so forth. But if you bought them in February near the lows and then you held on to them all the way into the end of the year, at one point you had about 15% gains. And then January came along and it was kind of scary, right? Made it look like, yikes, it was going to be a bad market. Well, if you haven't sold out in January and now February's back up, you're looking at that and saying, hey, I got some profit here and I could take this and get some lower tax rates. See, this sort of dynamic has occurred before. You get a reasonably big jump right here, and then 56 weeks later, there's a little bit of selling. Now, it's not very much selling, so the next move up should be pretty good, and it is. And 56 weeks later, you get some more selling. Not very much, so it goes up good. Well, now we get a lot of selling in here. Notice that although it starts pretty good, it doesn't end up quite as strongly. See what I mean? And then you get a little bit of selling, and we take off, and then the bear market starts. So anyway, that has actually been repeated, as you see here, a number of times. So that is the kind of thing that is the market, the overall market setup. Now let's talk about the specific market setup for where we are right now. Could it possibly create a situation for us that we would see this opportunity? Well, as you can see back here in, this is 2012 summer, June, July timeframe. Right after that selling was done, then early August, there was some buying. And you go fast forward into the August-September timeframe of the following year, and sure enough, there's the selling. Then comes the rapid buying. So we start here, we go forward, there's the selling. Right here, there's some rapid buying, and you go forward, there's the selling. See, all right, so if we come right here to the beginning of February last year, there's a little bit of buying. It's not quite as dramatic as some of these, but it's strong enough for us to say, well, look, they went to work here. It's possible that they're going to come back home from work, so to speak, that they're going to do some selling in the next month. That's what we're looking at. Then, after the selling is done, when their support level sort of bottoms out, that's when you're looking for opportunities. And how will you know when it's done? Well, look, last time it did it, it's your candlesticks. That's what. See right there, we had this huge candlestick, this big hammer candle on a weekly chart right there in the middle of October, just telegraphing. You got the morning star formation, just telegraphing the fact that, hey, that's it, that's support. But what's more important is that you could anticipate it was coming, see, and then when you saw it, you would know, all right, that's it, I need to jump in here. And so that's the kind of thing that you're hoping to see in the weeks ahead. So that's the setup. Now, what about the possibility that it would happen again? If, in fact, you did know that this was going to happen, is that all you need? Do you just say, well, there's the selling, just like Gordon said, I know it's going to go up from here. Hey, look, we never know. Even great candle patterns don't telegraph the price 100% of the time. You've got to set up your risk management, and you've got to recognize that, trader naivete is that all you need to know is the direction. But experienced traders know better. Knowing the direction is not enough. Let me give you a couple of examples of people that I coached individually over the years. Investor number one had a simple plan of just taking quick profits on a volatile stock. That's not a bad idea, but they were expecting, I mean, their idea was to try to win all the time, and so their expectations were a little unrealistic. They won 12 trades in a row and thought, this is it, I've got it figured out. And so they figured it was a sure thing, and they began to ramp up the size. Got up a very large trade, and set that up for a next trade, but it was a loser. And it was such a big loser that that investor lost all of their gains and all of their principal because they simply didn't listen to all of the instruction that they had to do all of their components in the trading plan. Investor number two is someone I did not coach, and this person bought a low-price stock in a hot industry. It doubled, it tripled, and it even quadrupled in less than 30 days. And this person was an acquaintance of mine, found out that I worked with Stephen and that I coached and was part of a group of guys that coach on the candlesticks and setting a trading plan all around the candlestick knowledge. Well, he came and asked me, okay, so I got this stock, right? Isn't this a good thing? I'm going to hold on. It's going to be a 10-bagger. I'm sure of it. In fact, I've heard from company guys that there's a big government deal coming, and it's going to make the stock worth a a whole lot more than it is right now. And I said, okay, but I mean, you know, do they know the future? I mean, I hear what you're saying, so that sounds like a great deal, but I mean, do you have a plan? Do you have a plan for, regardless of what they say is going to happen, you know how to react if the price does something and gives you a message that you need to respond? Well, that individual did not, and as a result, when the stock dropped 80% over the next 4 months and then went sideways for 2 years later, they held on and rode through all of that. I mean, you do the math on this and you realize that they were down about 20% on the position and just sat on it for all the time. Didn't end up being catastrophic, but compared to what they could have had, it was highly disappointing. And a third investor, again, someone I did not coach, sold put options on a Fortune 500 company stock priced near historic lows. Now, I know some of you are saying, oh, Gordon, sold put options, stop right there. I know where this is going to end. Others of you might be saying, oh, I just learned how to sell put options and it's been working out great for me. Is there something I don't know? And others are saying, oh, I don't do options, so this doesn't apply to me. Well, I hope that regardless of what the details of the story are, you're getting the message. See, the only chance this person could lose the way they were trading was if the company actually went under. It's a Fortune 500 company. It's not going under, is it? Well, actually, the company was Lehman Brothers, and this was 2 months before September 2008 when they sold these put options. And yeah, it went to zero, and their losses were catastrophic. So once again, the whole thing here was that these investors were trying to pick the sure deal, the single trade that was right, and they didn't need to do anything, and it was, you know, the lottery ticket, really. What they didn't have is a full plan. It's not enough just to know the direction and sit back. You have to have a plan that you can confidently execute. For example, one component of the plan is just trade planning. How are you going to respond? Trade planning is more important than entry. Let me take an example of something that Stephen teaches, which is excellent. You all know, I imagine, what this little pattern here is, this bearish engulfing candle pattern, right? But what you may not know is that unless you've heard Stephen on one of his modules actually say this, which he does, the bearish engulfing candle pattern is not a statistically high probability candle pattern. A lot of people think it is, but it occurs frequently, and in reality, it is not often followed on by a big downward move. In order to verify that, in fact, there will be a downward move afterwards, you should watch for a couple of things. You should watch that the low, or I should say the closing price on the second candle is exceeded the very next day, and the more the better, right? But if it just barely exceeds and doesn't even exceed the low, if it exceeds it at all, that's good. But if it doesn't exceed the low, then that's kind of weak. If it exceeds both of them, you're in good shape. And one of the things you do to help anticipate that that's possible is just simply look at an indicator like the stochastic or the RSI or maybe the CCI, one of these oscillators that runs up, and what you're looking for is a cross. If it's above the overbought line, you know, usually 80 or 70, depending on which indicator oscillator you're looking at. If it's above, and if as a result of the engulfing pattern it makes a cross, that's what you want. That's what you want to see, because when that sort of thing happens, then you're more likely to get a better result from it. So it's what you do after you get in. So imagine you got in here and maybe you went short, or maybe you bought put options. At what point would you say, okay, I have a limit. I can only take so much if it goes against me. Well, the top of the candle is usually a pretty good limit, right? And so how about this one? In here, we get a situation where let's see if I've got that right. Trying to advance the slide. There it is. Okay, so this is actually a chart from Apple a little while ago. And as you can see, it did not exceed the bottom on the very next candle. It did a couple of candles later, but that tells you this might not be a strong one, right? So you've got to have the stop loss there. But later on, another one comes along, and without having stopped you out, you got the sort of evening star pattern, which is a lot better here, and that has all the characteristics you need. And in fact, this has a lower high on the oscillator with a cross, and that gives you the notion that it's really time to let this thing ride. And then as it comes back up, you've got the crossover that confirms, okay, that's that gap, that's time to take profit. And so you can make a much better trade because you have all of these rules that help you recognize what to do. I mean, you could just say, well, as soon as it goes down a little bit, I'm going to get out 1 for 1. So if I'm here, I'm risking to there, and the distance that I'm risking to my stop loss, I just add that again, and I'm going to take that. See, then you get in, you get out. When this happens again, you get in, you get out, right? It's possible to make 2 small trades here, and or 1 big one. Either way, it's fine. It's just that you've got to have those rules defined, and you got to stick to them. I was reading a study earlier today, academic study, which explained that the ability to stick with your trading system is more valuable to you than the system itself. That's statistically proven. So interesting idea, but that's a key thing. And then in addition to this idea here, we should point out that risk management is even more important still than trade planning. So risk management is just the whole question of, do you know for sure what the right number of shares or contracts to use on these trades would be? So if you were in here and you were going to get out there, or if you were going to get in here, well, let's say here. If you were going to get in down here after the drop and go short, but your stop loss would be way up here as opposed to this one. Would you know how, would you just take the same approach? Well, I'm going to buy 10 put options for either this trade or that trade. Well, doing so would change the risk profile of both of those trades. And that's not the best way to do it. So one of the things we do in working with people, working with candlestick students, is to help them take their candlesticks and put them into a trading plan, a trading system that helps them recognize how you're going to get out and how you're going to keep your risk equal and how you're going to ensure that you're going to be consistent as you go. We help people go through simulations and through a tracking mechanism that really builds in the discipline. So, and we give them the statistics to help them know what to expect. What kind of losing streak should this particular candle strategy provide for you, or what kind of winning streaks? And so you have your expectations set appropriately. You know, hey, if I'm 4 in a row loser, but that's okay because this particular strategy I know throws off 7 or 8 losing streaks in a row, and I'm position sizing appropriately for that, so that I'm not thrown out of the game. I'm still in it. Or I don't like that kind, so I'm going to choose something that gives me a winner 3 out of 4 times, and I know how to handle the risk that comes with that. So these are the things that we do when we put a trading plan together for people, so that even if they do have a good idea and can anticipate when would be the right time for me to be looking for candlestick opportunities, what would be a really high-powered opportunity for me to take a morning star or a bullish engulfing pattern or so forth, right? If you can anticipate when that would be, and you've got a good plan for how to adjust to it, well, then you can really be a lot more productive in your trading. Effective trade plans include systematic entry and exit strategies with risk management techniques, a plan that fits your personality, and a plan that helps you know what to expect. Well, I hope that this has been useful examples for you, because one of the things you want to remember, of course, is that knowing the direction is not enough. You have to have a plan that you can confidently execute. Okay, I'm going to turn the time over to Joseph to explain a little bit more about coaching. And until next time, folks, take care.
Let's see, Gordon, is his sound working? Hold on for a second, folks. Again, the purpose of this session tonight is not to, there's no product to sell. We're just trying to get people acquainted with our mentoring group, which is a lot more comprehensive than my training. So, anyways, where's Gordon? Is Joseph coming on? Dr. Joseph?
Hey, Stephen, can you hear me okay?
I can hear you. Can everybody else hear Joseph?
Okay, just reply in the chat box, okay?
Okay.
All right, I apologize for that. I was talking for a few moments and then realized you couldn't hear me. So let me start again. Again, my name is Joseph Anderson. I am the program director for Stephen Bigelow's Candlestick Trading Form Personal Coaching, and I've been asked to come on this evening and briefly explain the opportunity of working with a personal coach on a one-on-one basis. We've identified a handful of expert traders in the markets who have agreed to partner one-on-one with a small group of students to mentor and to teach them how to be more profitable in this market in a faster and simpler way than doing it on your own. Now, so we've identified 5 coaches. Gordon Scott, who you've just heard from, is one of those coaches. And what I want to do is briefly explain the opportunity of working with one of these coaches one-on-one, and then for those of you listening this evening that are interested in getting more information, I will go ahead and explain the next step of that. Okay? So there are 6 commitments we make to every student that becomes a part of the coaching program. The first commitment is to clearly identify your goals and objectives. Okay? So what your coach will do, the first thing your coach will do is quickly assess where you are now versus where you want to go. You would be amazed at how many investors we work with from all over the world that do not have a clear goal or objective in mind other than just to make money in the markets. But your coach will not, basically your coach cannot lead you until they understand what it is that you want to accomplish. Now, once we understand your goals and objectives, then you will be ready for a customized plan to be created for you. We will understand your financial reality now versus what you want it to be. In essence, we will see the world through your eyes and gradually expand your vision to a much larger picture than you can see right now. So the first commitment is the identification of your goals and objectives. The second commitment is the development and implementation of a strategic trading plan. Now, this plan is here to serve as a blueprint or a roadmap for you. It will ensure that you reach your financial goals and objectives in the time frame that you tell us, if not faster. Now, as most of you know, there are a lot of ways to trade. Okay, there are a lot of ways to make money in the markets. But what your coach will do is work with you in developing a plan or a system specific to you and your situation. Now, everyone is different. So as your coach understands the specifics of your situation, he is going to identify what the best strategies and techniques for you are. Now, in developing this plan, the secret to sustained success is really to master 3 to 4 key or core strategies. The reason I say that is there are a lot of strategies out there that work, but there are no strategies that work all of the time. You need enough strategies so that regardless of what the market's doing, you have ways to make money. At the same point, again, you don't want too many. It just becomes noise and clutter as you go about your system. But again, you want enough to be diverse in the markets. Now, mastering these strategies will happen fairly quickly, and this will allow you to reach your financial targets in the fastest time frame possible. Also bear in mind, there is going to be a high level of accountability involved in coaching. Your coach will hold you accountable to this plan. So if you're going off track, he will kindly but firmly get you back on track and keep you focused. Now, one thing I'd make clear, okay, this is not a get-rich-quick scheme. Coaching is not designed to be easy, but to stretch you. We're going to challenge every rule you operate by, and in doing so, you will become more aware of opportunities in the markets that you simply wouldn't have seen otherwise. The best part is that you're no longer on your own, but you have a mentor or a team of mentors guiding you safely through every step of the way, so you do not make the mistakes you might have made had you been doing this by yourself. I'm going to go through these next commitments very quickly. Okay, number 3 is expert enough to coach others. Now, we're not talking about you becoming a coach for us, but rather your own level of proficiency will be such that you could literally coach someone to success the same way we would have done with you. Whether that's a family member or a friend, we believe one of the best measurements of what someone has learned is their ability to share that knowledge with others. Okay? The 4th commitment, positive results. Okay, making money. Now, we know that your interest is in doing, not just learning about doing. So many people spend so much of their lives in a state of getting ready, to get ready, and never really focus on the most important part. That's the execution, the doing, taking action. So the 4th commitment is simply to teach you what the most successful traders are doing, and then to actually do it with you. And as you create a strategic plan and follow those rules, you will start to see the types of gains on a consistent basis that will get you closer to your financial goals, which is obviously what you had in mind to begin with. Right? Number 5, customization of the entire learning process to you. So during this powerful learning experience, your coach will customize every lesson to your level. So if you're a beginner, we will move at a pace more compatible to beginners. If you're an intermediate trader now, then we'll move at an intermediate pace. Or for those of you that are at a mastery level, which usually means you're doing this full time, then we would customize coaching to that level. This is not a cookie cutter approach where one size fits all, and we understand it. Okay? And finally, the 6th commitment is cementing the habits. Your coach will instill or cement the necessary habits for you to become the investor you're saying you want to be. Now, part of cementing the proper habits is fixing any bad habits you might have incurred over the years. You see, habits are the key to consistent success in the market, and we know that. And that's why it's important that we make sure that you have a plan or a system in place, and that you really learn to follow that system. Okay? So those are the 6 commitments that we do make to each student that becomes a part of the coaching program. Now, I apologize for the audio. I went through those commitments very quickly. For those of you that feel like you may be interested in getting more information, if you're serious about making this coming year your best year ever, I invite you to apply now, find out whether or not coaching is a good fit by simply clicking on the link and submitting your contact information. Now, you will also be noticing a poll appear on your screen, which will have 3 different options, okay? Let's see here. Okay, so you should be noticing a poll appear. There we go. The poll's going to have 3 different options. Option 1, yes, please contact me. Option 2, maybe, but I need more information first. I can imagine a lot of you have additional questions. Or option 3, not at this time. For those of you, before I hand the time back over to Stephen to close up, for those of you that are anxiously or eager to get your trading off the ground, I invite you to again explore or entertain the idea and find out whether or not there's a fit between what you need and what we offer. Okay, and so for those of you that selected options 1 or 2, one of our customer service team representatives will be contacting you here in the next day or 2, and then we'll be scheduling an appointment for either you and I or one of our other colleagues here to go over the details of the program in a little bit more depth. With that being said, I look forward to getting in contact with those of you that are interested in getting more information. And with that being said, again, I'll hand the time back over to Stephen to finish up. Stephen, when you're ready.
All right. Thank you, Joseph. And everybody, this was more of, again, we're not selling anything. We're just trying to get educated or get information to the people that have been contacted by our training group. Because we get emails every day saying, I talked with this guy, is he legitimately with Candlestick Forum? And so if you hear from one of these guys, yes. Michael, don't worry, we're not trying to push anything down anybody's throat. We've got enough interest from people saying, number one, who are these fellows? Gordon and Joseph, they've all been professional trainers for years. What our problem was, or what my problem was, is I'd like to have everybody obviously know candlesticks and know how to trade them well. But since I kind of trade on a narrow band of information with one set or a set of indicators, I'm kind of missing out or having people miss out on all the other aspects of technical analysis that you can assimilate with candlesticks or improve them. So the reason I'm doing this is I tell the story that when I was in high school, I was pretty good at math, but believe it or not, I think I got a D- in, I think it was calculus. And I just couldn't get it. And then I took summer school with a teacher that my sister had before I got there. Was a very good teacher, and he taught it in a different manner where it just all became crystal clear. So there's a lot of people that get candlesticks. They're just not quite over the top. We're augmenting it with another training group that probably has a lot more skill and talent than I do to get the full understanding for somebody in there. I get plenty of people saying, I just love candlesticks. I know how to use them. I just cannot put it together. This is an opportunity. So anyways, thank you, Gordon. Thank you, Joseph. We'll be talking with you guys again tomorrow. So anybody, if you're getting calls, these are the guys that these are with the Candlestick Forum. They're my training group. So with that, hold on for a second. I don't want to. I'm going to go ahead and, Jim, I'm going to go ahead and close the slideshow, and then let me bring up some charts. So we'll go through some charts. We probably won't take as many requests afterwards, but there's some interesting things going on in this market right now that everybody should be aware of. Let's see. Here we go. Here we go. Let me make sure. All right. All right. Can everybody see the charts all right? Are we up and running? Okay. All right. Let's. Okay. As we can see, we did some backing and filling today in the Dow. Are we ready to turn over and head back? Because we're right back at the same levels that the market turned back before. So the evaluation has to be, we don't have a convincing sell signal yet. We've got some hanging man signals up here. We got stochastics in the overbought area, but there's one major criteria that's not confirmed yet. They haven't been able to close below the T line, and it looks like they're using the T line as support. That's on the Dow. The S&P 500, a little bit less selling in there. They opened this up a little bit lower. So we're still pushing this area. We're still in the overbought area. We need to see signs of whether they're going to start bringing it back or taking it up. Now, you can't, that's why I tell people a lot of people say, well, why do you use the Dow? Why don't you use the New York Exchange? The S&P 500, because they all represent something. T-line is the 8 exponential moving average. Very important factor. If you see a candlestick buy signal or close above the T-line, you stay long until you see a candlestick sell signal and it close below the T-line. But notice what happened here at this breakout level. We had that little morning star signal. It usually acts like a slingshot effect. Next day, they opened up positive. They were still pushing on this level. And then notice what they did at the resistance level. They gapped it up through that level. So right now, not only are we above the T-line on the NASDAQ, but we're still staying above the 3 T-line, which is an indication that there's still a lot of strength in this market. So if there's still a lot of strength in the NASDAQ, we've got to kind of assume that unless we see something severe happen in all the indexes, and the Dow is still above the T line, but we're still in an uptrending market. Oh man, this is not good. Just wrote down all the ones that I wanted to show tonight. So what kind of assessment do we make in the markets right now? Well, there's some sectors that are acting strong. There's some sectors acting weak, obviously. But if we look at what's going on in the one of the strong sectors, which is the oil sector, because crude oil had that big morning star signal, it's been nudging up against the 50. And notice, I mean, this is where you kind of observe the obvious. The obvious is that the 20-day moving average appears to be acting as support. And right now, after hours, we're trading up a little bit positive from where they closed it, which still gives us the impression or the visual analysis that we're in a slow uptrend. Now, if they break through the 50 again, and they break through this level, because of what the crude oil prices have done over the last 6 months, which is it's had this hellacious decline. I don't know what that is. They break through here, there's a good possibility they could be popping this up, and I'm trying to make this even smaller, to the point where if you, you put your Fibonacci numbers on here, Fibonacci numbers are up in this range. So all that really tells us, or what should it imply to us, is that if crude oil is going to bounce back up, let's say even to the $65, $75, or $70 range, that means over the next few weeks, more than likely, the oil stocks are going to start back up again, which they've already done. That's why we recommended the WLL, not so much because the chart was telling us it's bottoming out, but this has been one of our long-term picks that you can find in the long-term pick area, because they're smack dab in the middle of the Balkan reserves up there in North Dakota, which at this point they're figuring those reserves about the same size as the Texas reserves. So there's going to be a lot of oil coming out of there, and Whiting oil, or Whiting Petroleum, is right smack dab in the middle. Now, here's another benefit we have with candlesticks because of the graphics. Notice where it opened today, way down here. So the 3T line is a 3 exponential moving average, which works more effectively when you start moving away from the T line. You start watching that to see if there's a reversal. But on this one, notice what happened today. They opened it after a doji. That should have warned us maybe we should be getting out. But after even a couple, not even a minute, they were already starting to buy. So what we could see visually was that once they opened it, the buyers are still there. So this makes for a very easy exit strategy if we need one. If it opened and started trading up and then turned around and came back down through the open, that's when you close it out, because that tells you they aren't taking it up. In this case, they took it up, or brought it right back up again, which shows good strength. They wiped out some sellers and came back up. The Rendy, the blue one is the 50-day moving average. The gray one is the 20-day simple moving average. And the red line is the 200. And again, these are the reason we have those is they're simple moving averages that every major money manager around the world uses to make their decisions about their portfolios. We just have the benefit of being able to see immediately what's happening at those support and resistance levels. Let's see. All right, so I'm going to get down here a little bit lower, down on the sheet. I'm going to be going into why we can use candlestick charts to anticipate what should happen. But here's one. I mean, this one's a perfect setup already. We've had a left-right combo. That's a doji followed by a bullish engulfing signal. Excuse me. Stochastics are not overbought. We're in kind of a J-hook pattern, and if they open this positive tomorrow, that's pretty much telling us they're breaking out through this level. There's new targets to look for, which is this target filling the gap up here at around the 52 or 53 area. Now what, let's see, smoothness of the presentations is suspect. You got me there. So what I'm looking for is I closed out the February calls today at a good profit, and I flipped over to the March calls because I've got a very simple entry or expectation that if they open this positive, we're in wave 3, and if wave 1 and wave 3 are equivalent, they're getting us up into the gap area, which means buying the, I think I bought the February 40s, I'm sorry, the March 40s for $2 with the anticipation they could move up into the $12 to $15 range. I think it was the 40s. All right, so as we can see, a lot of the oils did the exact same thing. They opened lower. Let's make this big enough where we can all see it. They consolidated and they came right back up. I wouldn't be afraid to be buying DNR tomorrow on positive trading, another J-hook pattern. When they open lower and bring it right back up, that pretty much tells you the sellers that were in here have gotten out of the way. And so when you get sellers out of the way, which one was it? I can't remember. No, that wasn't it. Bah humbug. There was one. I can't find it. There was one that was in an uptrend and did a belt hold signal. Basically, those opening lower and coming right back up into the trading range is a, well, here's kind of that belt hold signal. Notice how they opened it here and closed it back up. They wiped out a lot of sellers. That tells you very easily that if they open this positive, you've got less sellers in the way now, and usually your price is going to move fairly fast. I would suspect they're going to come up here and fill this gap. Was it EOG? That was got a good belt hold, yes. And a belt hold, for those not familiar with all the signals yet, is a belt hold is when they gap it way out of the trading range and bring it back up into the trading range. Doesn't have to do a signal. It just has to come back up into the trading range. Was EPG another one, or did you miss? It must have been EOG. So the reason they call it a belt hold is the Japanese rice traders describe it as two sumo wrestlers fighting. One's trying to back out of the ring, the other one grabs his belt and pulls him back in, and they're back to wrestling again. Let's see. I'm going to take a look at a few good-looking charts here, and then I'm going to get into some topic ones here in a minute. ARNA. Observe the obvious. The obvious was when they got back down here to the 50-day moving average, they're doing our J-hook or our rounding bottom pattern. And notice what started this one up. A bullish candle bouncing right off the 50, and then your doji sandwich. Then another doji sandwich type trade right here on the 200. When you start seeing doji sandwiches, there's one thing that you can really anticipate, that there's going to be more upside. So essentially, this makes for a low-risk trade that you can be buying here. If it came back and closed below the T-line, you're out. If it moves, you're probably going to move at least up to this level, and probably the same magnitude move as this, maybe not in one day, but that's going to create a good, looks like about a 30% upside potential for you. Let's see. And Juno, notice how it's bottoming out. Doji, bullish confirmation. Next target, back up here to test the highs. Oh, there are numerous voices. Is everybody else having sound problems? Maybe you're listening to somebody else's Lloyd. All right. This is another one that was identified in the chat room today. Notice the Morningstar signal. Here's the important message, or the important information. Not only do you have a reversal signal in the oversold conditions, but today they told you the downtrend is over because they broke up through the T-line and stayed there. I wouldn't be afraid to be buying this one with the expectation that you've hit a bottom right on a parallel top. You're up here in about the $34, $35 range. OPK, another one that was identified in the chat room today. Notice what this one has done. This is why the Japanese rice traders say observe the obvious. The obvious is this has been staying above the T-line. Now we have a J-hook pattern. This one's very simple. If it opens positive tomorrow and breaks this level, if this is wave 1, wave 3 is going to be the same magnitude, about another 3.5, 4 points to the upside. Let's see. Yeah, so notice everything that we can identify on this chart. If I can make this big enough. This is what we call the message. Notice how flat you were trading. They gapped it up, and even though it traded back on the day, there was a message here. But there was a new dynamic in this stock. So what do we look for? We look for the profit taking to be over, and it did it with a Morningstar signal. Then you can pretty much observe the obvious. You can stay long, and here's why knowing what to do based upon the T-line. Hold on, let's see. Whoops. Hang on for 1 second. Whoops, what have I done? Ah, that's this. Okay. All right, so notice our little scoop type pattern took the slingshot effect. Now we're in a J-hook pattern. This is why recognizing what human nature does time after time allows you to take profits when it's time to take profits and get back into a trade when it's time to get back in. And or if you miss this move, you know there's a high probability that this move and this move are going to be the same. So it just sets you up for another good trade. All right. Let's see, what else did I have here? There was something here. Oh, again, notice where our piercing signal occurred. Right here off the 50. Closed just above the T-line. Makes this very easy for an entry. If it opened positive, what is it doing? Number one, it's telling us that they're confirming the piercing signal. Is there no screen up? Has everybody got a screen up? You're confirming a piercing signal, telling you there's a buy signal right smack dab on the 50-day moving average. And if it opens positive and trades positive, it's telling you the T-line is not acting as a resistance, and it's breaking this little downtrending channel, which means your next likely target could be all the way up here, or at least back up here to what everybody else would be watching, is filling the gap up here at around the $14 range. Now that's a significant move. That's a stock that has been obliterated. Stock that came from 25 down to approximately 6. Worst case scenario, they could bring it back up probably to a Fibonacci number, which would also correlate with filling this gap. Now, when I say it could come up to that level, is that where it's going to go to? I have no idea. The target is the potential here. So if I look at a chart that has a potential chart or a potential of being up 140%, or another chart that has a potential of being up 4%, I'm probably going to go with the one that has the big upside potential. Will it get there? Have no idea, but that's the potential. My next process is, if I'm in this position, I watch to see what type of patterns it does on the way up. What about stochastics? Stochastics telling us that it could be hooking back up again. We're definitely not in the overbought condition. Yes, anytime I do an analysis of any price move or any market move, it's based upon what signals are we looking at, and then you can start adding all the other confirming indicators to it. XLRN. Nice little J-hook pattern, more than likely moving back up into the trend channel with the possibility of heading for the top of that trend channel. And DSKY. This is what you kind of look for. Notice what it did. It came up through the T-line, came back to it, and there's our little Morningstar left-right combo. This is what we kind of call the stutter step, where it starts up, they pull it back, and then they do another buy signal. That usually tells you there's going to be more upside. I would anticipate the 50-day moving average. So basically, knowing what the patterns do puts you in situations where you get into high probability trades. Came up through the 50, came right back to the T-line. Why does this get so small? And then notice what it did today. After supporting on the at the 50, it did a left-right combo, confirming this kind of J-hook pattern in progress. If this is wave 1, wave 3 should be coming up into this range, or at least giving you a possibility of another 20% to the upside. The 3T line, when you start moving too far away from the T line, it starts acting as a kind of an indicator that if they close back below the 3T line, they're probably going to come back to the T line. So it gives you a little bit quicker exit and entry strategies, or at least being able to visual. GM/F, good charts, left-right combo. Oh, Ford and GM, left-right combo. I don't see it, but Ford right now has a nice J-hook pattern. OA, there is something absolutely wrong with this. Well, I'll be a son of a gun. I don't have any idea what that is, unless I've gone to now. I don't know what's happened there. Well, I was going to illustrate that once a chart, that's the ISIS. Now this is one I'm going to kind of lead into in our anticipation that if you, once you know what should happen in a price trend, for example, when you're in a price trend, they pull it back, you usually move right back up to the price trend. So you get a nice strong move right in here. Big move, pull back. It's got the possibility of coming right back up into the price trend. So this could be a good strong move right here. Now, what makes it a good possibility of a good strong move? Because we had a Morningstar signal, we had a doji sandwich. We're kind of hovering right here at the 50, and we're staying above the T line. Let me make this bigger so we can see what we're looking at. And notice what type of day we did today. Did another doji day, which tells us something very simple. If they open this positive, the simple rule of doji is they're going to move positive. And if they move positive, more than likely they're going to do a doji sandwich, which means they're going to have another day of this same magnitude. So this is a perfect place where you start buying options, because two things are going to happen. One, if they open up positive, you're probably going to get a good strong move, which means they are confirming the fact that they're doing a J-hook pattern and will eventually come up here. And two, if they open it lower, you close out your positions immediately, because that's exactly which way they're going to take it. And if they take it back down, what's that telling us? That's telling us that the 50 is acting as 50 area is acting as resistance. You want to be right back out of that trade. Sound is terrible. Oh man. I don't know. Maybe it's just my squeaky voice. All right. Now, so the reason I'm showing this chart is because this is what you kind of anticipate. You have strong reversal. You have a potential of a J-hook pattern bringing you back up, and you have the entry strategy that if it opens correctly, if you bought calls here, they're all already going to be profitable, and then you've got some big profit potential to the upside. There's an inverted hammer. Remember our statistics, unofficial statistics of an inverted hammer? You see an inverted hammer trading positive the next day. Notice what we've had down here. Morningstar, doji. Now they did an inverted hammer, bullish confirmation. Where's your next likely target? Probably coming back up to test the 200. All right. Sound is really terrible. please speak directly in the microphone consistently. No, I tried to. It doesn't move. The only thing that moves are my flapping lips. All right, let's see. ATHX, notice where it broke out. These are the type of things that you can use to your advantage. When it's closing as a doji right here, you get ready to buy on a positive open, because if it's a positive open, what do you have? A doji sandwich setup, and if it trades this same magnitude move here, what's it telling us about the resistance level? Resistance level is not going to be there anymore. All right. Okay, so here's what we do with anticipation, and that's why you want to be able to recognize different price patterns. If I see a doji right here at a resistance level, I've got a fry pan bottom. If I'm not alert enough to buy stuff right on that afternoon, I'm buying the next morning on a gap up, because which way are they going to move it after a doji? They're going to move it in the direction how they open it. If they open up positive, especially gapping up, what did that tell us about this resistance level and the 50-day moving average acting as resistance? Telling us it's not there. There's a whole new dynamic. Now you've got an island reversal. More than likely, this is going to be a strong move. Anytime you see that doji gap up, you're going to have a strong move. That's your best friend. And the reason we call it your best friend is because if you see something like this after a day of indecision and they pop it big, not only are you going to be in a uptrend, you're going to be usually in a very strong uptrend. The reason we call it a best friend is not only is it a strong trade, but the frequency of a doji gap up is extremely good. That you can make your living just trading off of the best friend signals. There's that slow curve. There's your doji sandwich that told you they weren't going to resist at this level. They gapped up through this area. Where do you think they're taking it to? Probably the 200-day moving average. And PEIX. There's a left, right, or a bullish engulfing signal right smack dab where the T-line and the 50 are coming together. Not so much the T-line, because the T-line's our own indicator, but everybody and their brother is probably watching the 50. So if you see a bullish engulfing signal right here at the 50-day moving average, a resistance level that everybody's probably watching, makes it a very easy trade. If it opens positive, you start buying immediately, and very simple trade. If it closed back below the 50, thus the T-line, thus, you close it right back out. But the probabilities on this type of signal is we're going much higher. What is the story with the inverted hammer? Vince, the inverted hammer is one of the 12 major signals, but it's probably got the highest highest probabilities that if it opens positive, or they open positive the next day after an inverted hammer, the probabilities are extremely strong that not only you're going to be in an uptrend, but you're going to be in a strong uptrend. Siri, doesn't matter that they're near an all-time high. They could be going to an all-time higher. What I'm looking at is what are the signals telling me? And right now, especially in the NASDAQ, it's telling us there's no selling going on yet. There's still, or even sell signals. So if you see that left-right combo right here at a resistance level, makes it very simple. Either you're buying on the close with the idea that if they open positive, they're going to be breaking out, and if they do, they're probably going to have a strong move, because what's everybody watching at this level to see whether they're going to continue above the 50-day moving average. Where do these charts come from? There's all sorts of charting services. These are CQG, which is kind of the grandfather of all the charting services. Quite a few of the quite a few of the charting services that you see on the for example, TOS uses CQG as their feed. It was one of the first charting services. Unfortunately, it's very expensive. I think I spend a little over $1,000 a month for these charts, just because I use them for writing articles or in the past books, because the graphics are pretty good on these. There is TSO. This is where you observe the obvious. The obvious is you're in a J-hook pattern. What did you have here? Wave 1. As long as you stay above the T-line, you stay long. If you miss the confirmation day price action, would you jump in on the next day? Yes, most of the time, just because you missed the first day or even the second day, you still have to analyze where are you in the stochastics and where are you in the trend. So I wouldn't be afraid to be buying this one, even though it was the day was to buy it today, but the message is still there. They've done a J-hook pattern, which this wave right here is probably going to be the same as this wave right here, so there's still a lot more upside. Now, a lot of people say, or look at a chart like this and say, oh, should we continue to buy or should we be buying here? The answer is, if you're buying here, obviously your risk-reward factor is a lot more dangerous than if you were buying right here when it broke through the T-line. So I tell people you can buy here, just be a lot more diligent as far as watching to see if there's any selling going on, or with 8,700 stocks out there to trade, go find another chart like this where your risk reward is much better in your favor. I use slow stochastics, and they're set at 12.33. Do candlesticks work on a weekly time frame equally as well as on a daily? They work just as well on a daily, weekly, monthly as they do on the 1 minute, 5 minute, 10-minute chart. Oh, that's the one I forgot to do. Is because we think that crude oil is still pretty strong. This is what it's doing right now. This is the crude oil chart. And right now it's trading after hours, trading positive, which we would expect if we're in an uptrend and we're bouncing off the 200. Is it showing a lot of strength? This is where you flip down to your 10-minute chart. And you can see that the 10-minute chart is holding up above the T-line. They aren't really selling it off. So, yeah, they work just as well on, as you can see, everything is the exact same on the 10-minute chart as you'd find on the 5-minute chart or the 1-minute chart, or if you went the other way. It all depends on what time frames you're trading. This is the 15-minute chart. This is the 30-minute chart. Remember, the candlestick signals are the accumulative knowledge of everybody buying and selling during a specific time frame. ARNA, no, that's still, whoops, wrong time frame. ARNA is just coming out, and it did a doji sandwich. Did 2 doji sandwiches. And what do we know about a doji sandwich? There's going to be more upside. These are just kind of very simple rules of each one of these signals and patterns. They usually, remember, the Japanese rice traders identified these patterns as being the reoccurring influences of human nature. That's why these patterns work so well, is because human nature doesn't ever change. There's kind of your belt hold. This is, again, part of that anticipation. If we've seen an uptrend, we're not in the overbought condition, even though we're at the high end of the scale, and we're sitting right here at a resistance level with a big belt hold signal. Very simple. If they start trading this above the 200, you want to be buying immediately, because that belt hold told us that they took out a lot of the sellers, and there's still going to be a lot more upside. And if everybody sees it coming through the 200, they're going to be jumping in also. So this is why, again, we want to try to have everybody's eyes acclimated to the signals and patterns. There's your fry pan bottom. There's your gap up. There's your doji sandwich. If it opens positive tomorrow, let's make this bigger. What's it telling us? It's telling us that this level right here is not acting as resistance anymore. And what do we usually expect coming out of a fry pan bottom? A very strong price move. WBC, notice the fry pan bottom, and notice how they broke out with that doji sandwich. Very simple rule that if you see a bullish day in a doji, if they open up positive the next day, you can buy immediately because the probabilities are extremely strong, but they're moving it in the direction of how they opened it. And if they did a strong day, what did that tell us? It tells us they're pushing right here on this resistance level. They're probably going to go through for two reasons. Number one, do we always get a big day like this? You do at a breakout level, number one, but basically candlestick signals put you in the right place at the right time, and sometimes that right place is a big price move. Vince, I'll take a look at a few. We're not going to do too many afterwards, but I'll look at a few. All right, we've been buying the fry pan bottom. That's why we recommended CEMP, because it's doing this fry pan bottom. It broke out through this level with kind of a doji sandwich. And again, this is where the analysis of what each candlestick does. Notice how they kept bouncing right up off the T-line. So they've broken out through this level. Where do you think your next target is? Well, there's the trend. They could come all the way up into the mid-30s, high 30s on this one. When you say open up tomorrow, do you wait the first opening price or wait first? Usually I want to see a couple of things that I want to see. First of all, I don't want to see that the Dow is opening up down 90 points. I want to see that the Dow is staying steady. I want to see the NASDAQ is staying steady. Then if something opens positive or opening, I want to see that they're opening positive, confirming the signal. So that might mean I wait 30 seconds, or if the market is a little bit sluggish and the stock is sluggish, I may wait 3 minutes, 5 minutes, 10 minutes, enough to tell me that the bulls are still in that trade. Let's see, I went to a different one. Okay, another one, SRNE. Another fry pan bottom, doji sandwich, breakout through this level. What's that tell us? That tells us that this consolidation's over. We're starting to head back up into what the trend channel should be. These not only make good stock trades, but they also make very good option trades. You just have, again, go with the charts that are telling you that the probabilities are the same as they always have been based upon that pattern that the Japanese rice traders identified hundreds of years ago. There's that little bullish engulfing. This is bind. I would suspect now that it's come back up where it came up through the 50. Notice the T-line crunch. After it pulled back, they couldn't close it below the T-line until it went through the 50. Now you've got a left-right combo. More than likely, if they're coming up off the 50, their next target is the 200-day moving average. Let's see. TNK, fry pan bottom breakout. Little doji type day. Makes it very simple. If they open this positive, you buy immediately because that means they're taking this one back up to the top of the trend channel. So lots of the reason we go with the price patterns is because not only do they give you a high probability of the direction they're going to go, but they also give you a much greater return than just a steady uptrending stock. What month option do you buy? Well, being that February is expiring tomorrow, I'm going with the Marches. Now, in our option trading room, there's lots of people that can take advantage of the weekly options, that if you see something about ready to break out, let me see if I've got something. If you've got something that you can see is about ready to break out or is breaking out, you might buy the weekly options. Now, I don't trade the weekly options, and this is the whole point of our mentoring group on here, there's going to be people that trade weekly options very well. There's going to be other people that want to swing trade stocks. Essentially, what you have to do is not only find what you like doing, but you have to learn how to do it well. So just because somebody else out there is trading weekly options, that doesn't mean you have the capabilities or even the mental, inclination to trade weekly options. You need to find the trading. I know the trades that I can't make because I'm not very good at them. I know the trades that I do well at, so I'd stay with those. Except I had to do that through years of experience, whereas going through some of these mentoring trainings, you're going to find out a lot faster what you should be doing and what you shouldn't be doing. Unfortunately, when we do a lot of the things that we shouldn't be doing, that affects our mental psyche. We think we can't do anything right. We only hit a few good trades. Well, maybe you should be concentrating on what you're doing to hit those few good trades. And let's see. All right, so HOLX has got a nice fry pan bottom breakout. And now the reason, a lot of people say, well, shoot, I don't want to buy a stock that's already up 3, 5, 10, 15, 20%. You do if you know it's starting your next wave up, and it might be up another 15, 20, 40, 80%. Let's see. RLYP. Retro. RLYP. This is where you observe the obvious. The obvious is look where the bullish signals happens, right? Smack dab on the 50, back up through the T-line, a doji sandwich. So what can we imply from this chart? More than likely, we're going to head to the top of this trend channel. And it could probably do that in the next 3 or 4 days, which also makes for a good stock trade or an option trade. All right, and this is what we call the message. The message is that even though it's gapped up and traded lower, it's gapped up. It's broken this downtrending channel. So when do you want to buy this one? When you see that the selling has stopped and the buying has come back in. And the kicker signal. Kicker signal is the strongest of all the signals. If you see a kicker signal, especially breaking through resistance levels, you're going to have a strong price move. That's why we recommended calls on ADP. Uh-oh. Well, shuzzbutts. APD. Oh, there it is. APD. Notice the kicker signal. This is the result. We also recommend flex for the same reason. The kicker signal, there's your result. So essentially all we're doing with candlestick analysis is finding the chart patterns that work over and over and over based upon human nature. All right, I want to take a look at a few of the biggies. Apple. Apple is another one where it did that. This is what we call the message. Notice that it gapped up and traded off. The message was that it gapped up. When do we buy it? The next day when it shows that the profit taking's over. Been acting well after that. Amazon, gap up. What do we expect after a gap up like that? A 45 degree. How long do we hold this? As long as it doesn't close back below the T-line. Facebook broke out today, and it broke out of this downtrending channel. I wouldn't be afraid to be buying this one. Now, there'll be a lot of times after a big day like this, they'll open it, trade it down, and then trade it right back to the top again. Get ready to buy it on positive trading. That tells you the profit taking of today was over. Let's see. Did we do Netflix? Netflix, another one where they gapped it up, stay long as it stays in this 45 degree. Notice the Morningstar signal right here. Pretty much tells you they're heading back up. Notice the Morningstar signal right here. Pretty much tells you they're heading back up. The T-line is the 8 exponential moving average. The red line is the 200-day simple moving average. Blue line is 50-day simple moving average. Gray line is the 20-day simple moving average. And the reason we use those is because the major money managers around the world use those moving averages to make their decisions. We just have the capability of seeing what those decisions are immediately. I don't use the golden cross. That's just a confirming indicator that the 50 is now coming up through the 200. My criteria, because I'm a short-term trader, meaning my trades usually last anywhere from 2 to 10 trading days, unless they get a run like this. I'll stay long as it doesn't close back below the T-line. Doji today with Apple. No, but notice, again, here's the 3T line. If you're in an uptrend and a stock's showing strength by staying above the T-line, it's showing more strength if it's staying above the 3T line. So I wouldn't be too concerned about this one. Now, on a short-term trade, yeah, if it started pulling back through the, or closed below the 3T line, that means it's probably coming back to the T-line. Use 15 minutes mostly during the day. No, when I'm trading, I usually trade, what was I trading today? Lean hogs. I was short, and then I turned them around because lean hogs basically did a doji gap up through this downtrend. That's your best friend. And I usually trade off the 10-minute chart. Whoops, we're on the 30-minute chart. So when it opens like this, I just stay long as you don't see a real sell signal to close below the T-line. Right near the end of the day, it got up the limit. Crude oil, same scenario. Late in the day, you can see, or at some point in the day, you can see that crude oil turned around. There's that big Morningstar signal confirmed. And then it does everything. This is the 10-minute chart. Prices do the same thing on a 10-minute chart as they do on a daily chart. Notice where it failed, or first profit taking. Right here at the 200 on the 10-minute chart. Came back to our T-line, did our bobble, came up through, did a shooting star, evening star signal. It was time to take profits. What was it telling us at that point? That they weren't taking it up higher. We needed to wait for the next buy signal. Right now, as you can see, and after hours, they're still slowly taking up crude oil. Which means if they trade this higher tomorrow on crude oil, that's where you watch. If we wake up tomorrow and crude oil is up another 40 cents, you probably want to be buying these type of stocks that are breaking out immediately. So this is just kind of simple analysis of what's the underlying factor that moving the crude oil price or drillers. It's crude oil. If it's coming up, if they're starting to break out through resistance levels, you want to be buying them. Okay, let's see. Just a couple here, and then it's time for our bed. We're already, oh, I've got you way over time. CLG, you can buy. It's just not a real exciting stock at this time. Mainly because the percentage move isn't going to be all that great. It's in a slow uptrend. However, it is bouncing off the 50 with a little Morningstar signal, broke through this downtrending channel. If you're trading calls on this one, yeah, expect it to come back up to the top of the trend channel. MAC, all you can do here is this is once you have your left-right combo confirmed, that you've broken the downtrend, just very simply, if you want to sleep well at night, just stay long until you see a sell signal. Now, notice where your stochastics are, and notice how far away you are from the T-line. And what's our simple rule of moving averages, support and resistance? Usually if they come up through a moving average, they'll come back and test it. So at this point, I would have my sell stop right here at today's open, because if they were able to bring it back down through that level after this uptrend, more than likely they're pulling it back. I want to take my profits and then see what it does at the support level. How do you work these if you work a full-time job? Everybody's time factor is going to kind of regulate what type of trading they do. Obviously, you can't trade intraday on if you're working all day long. But if you have the capabilities of getting into the or checking your positions at least once a day, even if it's at night, you do swing trades, which means if you buy a position, you hold it until you see a sell signal. You don't have to. Most of my bigger portfolio trading is swing trading, where I don't have to make my decisions but once a day of whether it's time to come out of that position. Oh, let's see. Just a couple more. Now see, here's an example of if you were in a strong uptrend, which you obviously were. This was your gap up, your consolidation. Then you were way up in the overbought condition. Up here, you were a good distance away from the T-line. Very simple. You put your stop at this level. It shouldn't come back down through there. If it does and bounces off the T-line, comes back up, you can always buy back in. AMPI is one of the ones that we've been trading. Oh, pshaw, what did I do? A-M-P-E. Different. There's your fry. This is what we call the classic. The classic is your big fry pan bottom. What do we expect coming out of a fry pan bottom? A strong price move. Where we see our first profit taking right here at the 200-day moving average with a bearish engulfing signal. What did it do? Did a bobble, which is when they sell at a resistance level and they support on the T-line, they're coming back up. So this is where I'm not afraid to be selling here and buying here, because I know that it has supported, and now we're in a J-hook pattern. What do we expect out of it from a J-hook pattern? First of all, our prerequisite is a very strong price move, then a pullback, and then the next wave is going to be equivalent to that wave. That's the classic fry pan bottom J-hook pattern. I don't buy all the stocks. All I'm doing, David, is analyzing which ones look good. My method of trading is to keep as much of my emotions out of my trading as possible. That's the big problem with the big bailiwick of most investors is their emotions. So I try to do everything possible to keep my emotions out of my trading, which means if I've got a portfolio, whether it's 100,000 or 1 million, I divide that portfolio up in equal shares, let's say 10 positions. That means each position is going to be equal dollar amount. And the reason for that is if I see the greatest setup in the world, and I'm normally trading, say, $100,000 a position, if I say, well, I'm going to put $250,000 in this position, what I've just done is I've stuck my emotions in there. I said, I'm smarter than the market. And now when I analyze that position each day, more than likely, if all my other positions are 100,000 and I just put 250,000 into that one, you can bet your dime to donuts that I'm spending 90% of my time watching that and 10% watching the other 10 trades. Then what happens is if it doesn't work and it keeps going down a little bit, because you put your emotions in there to say this one's really going to work and it's going down, your rationale is, well, everybody, this is going to work. Everybody else isn't seeing it yet. And you come out of the position 3 days later than you should. So you had to finally make a decision on your favorite position versus saying, all right, this is one unit of my portfolio, sell that unit and go on to the next one. So no, just because there's 30 stock recommendations, each day I might only shift one or two depending on if I've got a position in the portfolio that looks iffy. And because our scanning technique is so simple with candlesticks, our candlestick analysis is if I can easily find 5, 6, 7, 8, 10 excellent trades the next day or positions to get into, and I've got one in my portfolio that looks iffy, the whole process of cultivating to make sure you're making as much money as you can based upon your risk factor is you come out of the iffy one and you put your money into something as high probability, lower risk than what you were coming out of. So anyways, no, just because we're recommending 30 stocks, each person has to decide which one they want to be in or the number of positions they want to be in, and there's a lot of stock positions you can't buy. SY, you can see it's moving sideways, but I'd be more apt to buy it. I hate that thing. When it broke through this here, that would tell me I'm in wave 3. So that long dissertation, David, was more to say that everything that can be, that we do or I do with candlestick analysis is just pure common sense put into a graphic depiction. And so most of the time when when I do trainings for people, most of it's, you're kind of sitting there saying, yeah, I knew that. I've just never seen it or watched it in that manner before. So there's our inverted hammer here on IMPV. Notice your T-line crunch is in progress. I probably wouldn't buy it right now, but I would buy it if it came up through the 50. Notice you've got this downtrending channel that if they broke through the 50, it's breaking not only the 50, but this downtrending channel also putting you into wave 3. Let's see, what else am I? I was short. A lot of people ask, well, does this work for commodities? You got to remember, candlestick analysis was developed on the most basic of all commodities, rice. And the Japanese rice traders didn't become wealthy trading rice. They became legendarily wealthy. They were the financial powerhouse of Japan for centuries. So the signals work just as well on a commodity chart. Here's coffee. I went short coffee as it broke down through this level on a evening star type signal. I'll stay short. Where's my first or next likely target? Well, if you can draw a line right down through here, I would suspect that's where it's heading to. A fry pan bottom is one of the patterns. There's about 5 or 6 patterns. Fry pan bottom is a slow rounding bottom that you couldn't trade one way or the other, but the results are that when they come out to the other side, it's usually going to be a very strong price move. This is kind of a buildup of investor sentiment. Okay, let's call it a night. I kept you all way up past your bedtime. We'll see everybody bright and early in the morning. Hope we'll see you in the chat rooms. We'll see you then.